love it. After 24 years of being on Toledo's largest talk station here on the radio, we've talked about the fact of retirement is not like it used to be, and it's really not your grandparents' retirement. You can't really use their playbook, if you will, for figuring out how to position your own individual retirement. I mean, it's good to learn lessons. I know I've learned a lot of lessons from my dad and my grandparents as well, and those life lessons are also very valuable. But in this segment, really what I want to do is I want to talk to you about 4 key ways retirement today is completely different. We're going to walk you through some of the pros and cons and what you need to know to really make sure that your plan is adapted to where you're at today in your journey. Number one, what you'd want to look at is people are living a lot longer. So you're going to want to expect to have a longer retirement. The risk that we're talking about here is called longevity risk. And there are ways that you can address longevity risk. And a couple of ways that you can address longevity risk is annuities would be one common example. Annuity is an insurance contract, and there's different types of annuities. There's, again, complete segments that we have on annuities talking about the pros and cons and ins and outs. But essentially, you have a contract with an insurance company that's designed to provide something guaranteed by that insurance company. And one of the things that you can do is you can get an income payment. That income payment could be either for a set period of time. It could be a period for the rest of your lifetime. If you're married, it could even have the option of having a joint payout for both of your lifetimes as well. So one of the ways that you can address longevity is you can get some insurance to insure against that type of risk. The second way that you can do that is focus on the income producing assets of your investments. As an example, in retirement time, not just having growth oriented stocks, focusing maybe more on dividend paying stocks. So if you have dividends, they tend to be more predictable than the ups and downs of the daily noise of the stock market. And in addressing longevity risk, one of the cornerstones of your retirement is going to be Social Security. There's a large percentage of people that just claim Social Security right away at retirement time and, take it before what's considered their full retirement age. You can even get a higher benefit if you delay taking Social Security to the age 70. But the great thing about Social Security, and I know Social Security is in big trouble, and it's broke like most of the other parts of the government, but Social Security is a contractual governmental guarantee that you're going to get this amount of money, and they're going to pay that income for you for the rest of the lifetime. And it's inflation-adjusted income as well. So making the right decision and maybe sometimes consider delaying Social Security can be a good way to help you with your longevity risk. And then also to deal with longevity risk is being too conservative. I talked in an earlier segment about clients who were very risk adverse and had chose to put the majority of their money into fixed income investments like money markets and CDs. And although that gave you peace of mind on your statement, when you subtract the amount of money that they're going to pay in taxes and inflation, they're actually slowly losing money, which for longevity risk does not work in their favor. So number 2 is pensions versus your personal savings. My grandparents used to go work at a company. You'd work there for 20, 30 years. You'd retire. They'd give you a pension that lasts the rest of your lifetime. Usually included some benefit for your spouse if you passed away earlier. Being here almost at 50 years old, for my generation and younger, pensions are a thing of the past. But the nice thing about pensions is, the pension for our grandparents would protect, in many cases, what they needed to live off of for their basic income needs. I think those same principles apply today as they did for our grandparents. Investors today or retirees today are really forced into saving for themselves in a 401k or an IRA. And so when you move into retirement time, what you want to do is you want to look at protecting that minimum monthly income needs with non-market risk investments. So you want to have enough reliable income that says, if the stock market doesn't go up or down, it doesn't have a big impact to the outcome of your monthly income needs. So shifting those risky assets to things that provide more predictable income. Again, example of that is you can use annuities that provide lifetime income benefits, have more dividend-focused investments. And if you don't want to do that, then what I would recommend is to at least have like a 5-year bucket of money worth of backup plan. So if you need $1,000 a month out of your retirement account, you want to have $60,000 set aside in an account that's not subject to the lottery of the returns of the stock market. And why I say that is because at some point the market will go down. And if you're pulling $1,000 a month out of your investments in a declining market, you don't want to be selling off your investments when the market's going down. So in a declining market, you can shift withdrawals over to that backup account, not being forced to sell your investments where they're temporarily down. In this case, 5 years, I think, would give you a pretty good probability of success that the market should recover. And again, you can adjust your withdrawal strategies, not selling when the market's down. Number 3, I think technology has improved dramatically in this industry, and that's a good thing to help you become a more educated investor. In the good old days, I used to have to pull open the local newspaper and look at the price of stocks and figure it out. Or if I wanted to figure out fees and expenses and performances, I'd have to look through a couple 100-page prospectus and go to multiple different places. It was a long process to be able to figure out the ins and outs of a portfolio. Today with technology, we can find out how optimized an account is. Is an account put together and constructed in a way that mathematically gives them the greatest odds in their favor to achieve the outcomes that they want to do. With technology, we can instantaneously stress test a plan that says, what would be the impact if I paid off my mortgage? What would be the impact if I took Social Security later versus early? What would be the impact of a market decline? What would be the impact of, my loved one or me going into a nursing home? And we can instantaneously, see what those results are because of technology. So retirement planning is very much improved today. The Social Security decision, I've seen some of the stats, and more people are delaying taking Social Security, and I think it's because of the fact that Social Security optimization software is out there, and it's showing people that collecting Social Security early may not be their best approach on how to get the most lifetime income out of the benefits that they pulled in. I think technology has improved in a lot of the portfolio software that's out there. We use a couple of different ones, and one of the ones that I like Morningstar. When I go on to Morningstar, I can look at financial statements. I can look at, what are the insiders of the company doing with their company stock? Are they buying? Are they selling it? I can look at the analytical data, and granted, I'm a numbers nerd, but I can look at like the price to earnings ratio. I can look at the dividend yield. Investors who own mutual funds, you can look at, what are any upfront or back-end sales charges. What are the annual operating expenses of the fund? And you can get that information pretty quickly using tools like Morningstar. And then the third in that category, or the fourth, I should say, is looking at using software to do tax planning. Developing a strategy that takes, the numerous laws that you have in the form of taxation and applying it to your situation to look for ways to reduce and minimize the amount of taxes that you pay. Says technology has improved to help make you a better educated investor. The fourth thing that is a little bit different on how retirement's different than in the past is chronic illnesses. We have America's Medicare Associates here. Not only helps with people that need health insurance before 65, but also Medicare and then Advantage and Supplement, but down the road dealing with the issue of long-term care. In the past, if I go back to, say, like my grandparents' age, if you think about like a diagnosis of cancer, a heart attack, a stroke, a lot of the times those were pretty terminal illnesses that you got. Today, with the advancements that we have in the healthcare field, people are living a lot longer with those chronic illnesses. And, what comes along with those chronic illnesses is helping you maintain control and independence. It also comes with maybe a heightened risk that you might end up in some type of facility, to need long-term care. The stat that I saw is it's, less than, I think, 5% of people have long-term care insurance, and being the fact that it's, a pretty high risk that if you or a loved one needs long-term care at four, five, $10,000 or more per month, you want to have a plan in place that's designed to leverage your assets. Again, this is an area where I think the insurance companies of America have evolved from our grandparents. So if I go back in time to 20, 30 years ago when I got into the business, a common solution years ago was to buy traditional long-term care insurance. And there's good thing and the bad thing about traditional long-term care insurance, but the insurance companies of America have really evolved today to provide a lot of different solutions to help a couple be able to protect their assets without having to erode their retirement accounts. You could have a life insurance that allows you to accelerate your benefits if you have a critical, a chronic, a terminal illness while you're alive. It just doesn't have to be life insurance for when you pass away. The insurance companies of America have evolved with annuities that offer income riders. And, those income riders are designed really to help somebody maintain more control and independence if 10 or 15 years down the road or longer than that, they need long-term care. So there's been some evolution. And when you think about how retirement is different today, it is a lot of positives, and then you have the negatives, like so much news media in your face all the time. So if you feel like you're stuck in the past and your retirement plan is not keeping up with today, I'd love to have a conversation with you and then show you some of the different tools and resources that we use to help make sure that your retirement is staying up to date with all the latest and greatest that's offered today.